Welcome to Investing for Generational Wealth. I'm Keshav Kolor from Clive Capital, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or cash flow, and tax benefits. Together with our investors, we've helped them passively invest into over 1,000 apartments and the ground-up construction of 500 single-family rental homes. Before we begin, a quick disclaimer: we are not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So perform your due diligence before making any financial decisions. And of course, consult your CPA, your attorney, your investment advisors, etc. before beginning investments. We're not professionals. We just like to dress up and hop on a podcast and chat on Wednesdays. So I'm your host, Keshav Kolor, and welcome to today's episode, The State of Apartments in Arizona. And today's guest is Jason Beakley. How you doing today, Jason?
Doing great. It's another beautiful day.
Where are you based out of?
I'm in Phoenix.
Phoenix, nice. That's an interesting market for sure. So, but I'm sure we'll get into that. So if you could just start our listeners off with your background, how you got to where you are today.
Sure. So I started as an appraiser's trainee. I was actually in college, and some guy was a guest speaker, and at the end of it, he said he was an appraiser, and he asked if anybody wanted to try. So I had no idea what that even was, and if I didn't even know a difference between commercial and residential real estate. He kind of took me under his wing, and he fed me through a fire hose of information for the next 3 years, doing all the apartments in Santa Monica, doing high rise in downtown LA, self-storage all across the country, and really just getting a robust education on real estate valuations. From there, I met my wife. We got married and decided LA wasn't the best place for us to raise a family. So I moved to Phoenix, got connected with a couple local firms here, and began appraising. And then COVID happened, and everyone thought the apartment markets and real estate was dead. I predicted with my boss, I think apartments are going to boom because everyone has to stay at home now and they want to live somewhere nicer. I'm glad I was right. Ended up doing well over 1,000 valuations those first 2 years of COVID, just all apartments, understanding what is the proper growth anticipations, vacancy, figuring out where the trends are for the Phoenix apartment market. So I'm a commercial real estate appraiser by trade, a candidate for my MAI designation, and an amateur apartment investor.
Amazing. And what is your goal long term? Is it to stay an appraiser? Is it to get more involved into these syndications of apartment buildings?
Sure. Yeah. So I don't think I will ever stop being an appraiser. It teaches you how to think, how to view things, how to value them. But long term, my goal is to either work with a fund or own my own portfolio of apartments. Just using all the skills I have as an appraiser, and bringing that to the table to go, this is where value is. Having good training wheels on my underwriting, and to recognize, okay, these are the fundamentals for why vacancy is where it is. Not just reading a CoStar report or someone's quick newsletter, but knowing what goes in the sauce.
Cool. Where do you get your data from? Like, what is it? What kind of data are you consuming? I guess that's really the big thing. I'm guessing that that's the big thing that the appraiser does, and then draws conclusions from that data. Where are you pulling that data from? What data are you looking at? Because I think we can't all be as sophisticated as you, obviously, but if retail investors listening to this podcast could be a little more educated about, how do I decide what's a realistic projection or a realistic assumption versus not, they'll probably be better protected from some of the syndications and investments that they get into.
Sure. I mean, first and foremost, I would encourage anybody, if you're a retail investor and you're considering going in on a property, we'll throw out a number, we'll say it's 10 to $15 million. It might be worth paying an expert, even couple thousand bucks to make sure the numbers are right. Because when an appraiser gives you an opinion of value under the definition of an appraisal, they're liable for up to 7 years. If that number is wrong or inaccurate or it was done poorly, they can get sued for a long time. So there really is a lot of assurance given from that as opposed to a BPO. That being said, if you want to do the due diligence yourself, you want to look at it. If we're looking specifically at apartments, right, you want to look at, first and foremost, I'd say supply and demand. The easiest one to calculate there is actually demand. So you're going, okay, for a market, and we'll say CoStar is your data source. I'm looking at the Phoenix one right now, and currently there's 493,701 units, give or take. Their vacancy rate is 10.4%. So more or less, like there's about 500,000 units that are needed for the market to be operating well. Because if there's only 5% vacancy or less, tenants don't have any options to go anywhere. It's a landlord's market. But the vacancy was 30%, you would know, okay, there's some supply chain issues. Rent will be going down. From there, we can look at the existing units, and we can look at how many are coming online. In this case, 30,718 units are proposed in the next 3 to 5 years. Not all of them will come to fruition, so you can take that number and multiply it by 0.5, 0.75, depending on what you think the efficacy of that is, and you use those to determine what's the residual demand in the market. So we take the total number of units that are occupied plus a vacancy factor, and then you subtract out the existing inventory and the proposed inventory, and that'll give you some rough understanding. It becomes more and more accurate if you narrow down your focus. So you're not saying the Phoenix metro area, one of the top 10 largest cities in the country, but you go, hey, what about South Scottsdale? Or what about Beverly Hills? What about the city of Pasadena? When you narrow down your focus, now you can really get into the minutia. The other thing I look at is population trends. And to be honest, nothing really beats. You look at government data for where it's moving, but then just go to any local retail nearby and just start talking to people. You'd be amazed what you can learn talking to a clerk at a grocery store. You ask him, how's his life going? How are things? If he's telling you he can't wait to leave, you're getting a good idea. I think things are going to go down. If everyone who lives here has a negative outlook, that's a good indicator of where things are going. But if everyone's saying, I really love it here, I love my apartment, I had a hard time finding one, okay, these are good signs. These are good signs. So, it's going to be a blend of everything. There's no one-size-fits-all database that you could just tap into, turn the faucet on, and you're good to go, because there's always going to be other factors you need to consider. So, that was kind of a lot, but I don't know if that answers your question.
It answers it a bit, yeah. I guess there's a bunch of other metrics too. What would you say your, top 5 are? There's supply and demand, and then kind of vacancy, population growth. I'm guessing, what kind of economic drivers do you look at?
Sure, yeah. So I obviously look at supply and demand. I look at population. I look at household size. So you'll notice in higher density markets like Los Angeles, San Francisco, New York, Chicago, studios are in high demand because people are eager to move out, eager to get their own place, and that's it's kind of the first step people get into really moving away from roommates. But when you move to markets like Phoenix, you go to Charlotte, a couple other ones in the Sun Belts, studios don't do as well because you have options, you have space. When I moved to Phoenix, one of my goals was to not be so condensed. I got a 3-bedroom. It was me and my wife. We did not need 3 bedrooms, but I loved the idea of having that space. knowing that when you're trying to look at markets, like particularly a year and a half ago, when the apartment started to slump a little bit, vacancy started to creep, it's not accurate to say all apartment vacancies are up. It just, that's misleading. But apart as tenants are struggling with inflation, you see some household reformation, and you see 3 bedrooms, 4 bedrooms, 5 bedrooms increasing occupancy, and studios 1 bedrooms decreasing in occupancy. So you're going to factor in what is it that we're really offering in this apartment or in this metro that is desirable, that's not desirable. You can look at job growth. You can look at how does the government perceive landlords? Are they quick to kind of clamp down and institute like a REAP program and really just crush people's hopes and dreams? Are they pro landlord and saying, hey, help your tenants, but you have your rights when you bought the property? And those will all funnel into what's your rate of return, or simple, above the debt service line. You're looking at cap rates, right? What's the risk for this property? Is this a low cap rate market? Is this a super high cap rate market? Why is that? Is it just historical trends, or is there real numbers that come into play? So I try to digest everything at once. As at least as an appraiser, maybe I bite off a little more than I can chew, but you have to look at all aspects to understand the number. Otherwise, you'll quickly get the wool pulled over your eyes. I've seen a number of people who, especially this is late 21, early 22. I was looking at some appraisals, and I had clients come up to me and say, "Hey, Jason, should I buy this property?" We're watching cap rates are compressing day by day. Value per unit is creeping up day by day, and it seems like it's going to go on forever. And we all know that's not the case. That's not true. So I had to open it up and go, okay, what really is causing this cap rate compression? Are the rents really climbing? Not really. What about the going in cap rate? What about the going in like as is condition? Let's look at that. Some investors, some syndicators might not care. They say, "Oh, that operator, he's an idiot. I'm going to buy it. I'm going to make a bunch of money," and that's hubris. And that's where a lot of people now are scrambling. You let your pride get into the way. You let your pride do the talking and the underwriting. Garbage in, garbage out. And now they're wondering, how did they find themselves in this mess? Really, as a good operator, a good syndicator, you need to look at this and go, what's the economic fundamentals that lead me to where I need to be? So you're going to consider cap rate, and just to reiterate, cap rate, current rental rates, current growths, understanding of market income and expense, and then just knowing your market. Like I said, like talking to people at the grocery store, talking to boots on the ground. Ask brokers, buying brokers, selling brokers. What are people asking for? Not what do you think you could sell for, but what is everyone who's talking to you asking for? That's a piece of meaningful data.
How do you evaluate? I think one way that people inflate return metrics on these indications is, well, 2 ways: cap rates and then growth assumptions for rates, or not rental rates, I mean, and expenses. How do you view those two? I guess let's start with cap rates.
Yeah, we'll start with cap rates. So cap rates they're first and foremost have to be understood. They're a derivative, right? They're not an actual inherent rate themselves. So you don't want to avoid markets simply because these are high cap rate markets or low cap rate markets, but they're just indicators of what's going on. So like in Los Angeles is a great example. They're a typically low cap rate market because they have rent control. So the second you have turnover, you can greatly boost your potential income into achievable income. So you're constantly buying it in hopes that you're going to get better. Similarly, if you're in a cap rate market where it's all 10s, right? There's not a lot of fluctuation up or down, but maybe you're going to do better overall. You really just want to go, okay, compared to other similar products, why are we the way we are? And I often find it in other brokers, when they present sales, they'll say, hey, look at these 5 comps. They're all a 5 count. So we will be a 5 count. Well, I know those sales because I did the appraisal. Okay, well, 5 count, that's based on what? Is it the potential income or is it the achieved income? If it's a pro forma cap rate, that might have been a 7. But if it was actuals, it might have been a 5 or even a 3. And there's a story that's needed.
Explain what you mean when you say pro forma versus actual cap rates.
Yeah, sorry. Yeah, if I'm speaking a little too fast, just stop me in my tracks.
Yeah.
With a pro forma, you're buying a property what you believe you could achieve. So let's say there's an underperforming asset and it's 10 units, and the NOI that they're receiving is, we'll call it $50,000. But when you do your underwriting, you say, well, these are what the market says it should be based on what I know. We shouldn't be getting 50, we should be getting 100, right? And so, okay, well, if I'm going to sell it for, let's say, $1 million, or we'll say $100,000, but you're only going to get they're currently getting 50,000 in income. So you take your 50,000, you divide it by the 100,000, that gets you a cap rate of 50% or 50 basis point cap rate. But if you bump up the income and then you do the analysis, you'll get a higher cap rate. So your pro forma income will be a higher NOI, which will result in a higher cap rate. And conversely, the as is income will typically be a lower cap rate. So when you're comparing, what is the market doing? If the broker or your operator, whoever it is giving you these comps, you need to know, what is that cap rate based on? It's not an objective measurement, even though it should be. Because if we're saying, well, ours will be a 5, well, that means it is lower. And if these comps, if that was their operating was a 5, we might be overpaying. And because of how it's related, you might be overpaying by 500,000-600,000. There was a deal I underwrote 2 weeks ago, and it was a $600,000 discrepancy. Small apartment, but that difference was, what was the cap rate based on? That was the only thing that changed. And that went from, we're going to make money, to, I wouldn't touch this with a 10-foot pole.
Yeah, that's good. That's a good nugget right there.
Yeah, so I hope that's helpful. In terms of growth and
how do you evaluate cap rate expansions? What do you usually say is safe to assume on the exit? Like, what kind of, do you just assume 10 bips a year, like a lot of people recommend? Do you assume something based on historical trends? What do you?
So you want to consider historical trends. You could consider things like 10 bips a year, but realistically, you're going, okay, if we go historical trends, we said 5 years ago, right? You looked at Phoenix. 2019 was a very different market from 21. For all intents and purposes, either 2019 or 21 and 22 are statistical outliers, but they can't demonstrate a trend, because you can't underwrite like this and go, well, it'll just be this way into perpetuity. Instead, you go, what informs the cap rate? How do I know what will be? Rarely will you see a cap rate, your exit cap, be less than you're going in. If we're going to analyze pro forma to pro forma, right? So we're talking apples to apples. Say my going in cap rate was, we'll say, a 9, right? Because we're going to renovate, we're going to flip a bunch of units, we're going to improve it. Okay, my going cap rate is a 9. Well, in that case, we would anticipate a lower cap rate on my exit, because we don't have all those renovations. We've absorbed a lot of that risk. It's stable. Okay, cool. If we're buying it at a low cap rate, the going in, now that's harder to anticipate that growth trend for where we're going to be. A better metric would be your yield. What's your yield? Or an investor term would be your IRR. You're going to take your IRR, maybe it's 25% or whatever that, and then you deduct your total change over that whole period. It could be 5 years, 10 years. If you're anticipating, call it 5%, or even 10% change in value over the next 5-10 years, plus a sinking fund factor, take that out, you'll find that cap rate will end up being very similar to that 10 bips a year or 15 bips a year. I mean, rough numbers, it's always safe to assume a 50 basis point increase on the exit, right? If your underwriting is pro forma, it's what you anticipate stabilized, say a 5 cap on my buy, I'll assume my exit will be somewhere between 5.5 and 6. Oh, the market's going to change a little bit. 10-year treasury might go up, might go down, but it's not. We're not going to get way down. We're not going to go way up. And I know that because I look at the trends, right? What does the population trend look like? What does the economic trend look like? What are the main job factors that come into Phoenix? Is it all real estate? Is it all development? Oh, that's a little risky. Okay, it's a little more stable. You use all these things to inform what you anticipate the cap rate to be. But you can kind of back into there by going, what is our growth rate looks like? So our income growth might be 3% a year. Okay, well then your expenses should also be 3% a year. And you can map that out over a DCF and go, okay, if I back that to the present, what does that IRR look like? Is that reasonable? Is that stable? And then you compare that to your other DCFs, what people are sending you, and if the numbers jive, that 50 to 100 basis point jump makes sense. So again, there's a lot that goes into the sausage, and there's a lot of areas where you can go wrong, and you end up really misleading or under projecting where you could go. But if you're looking for, okay, I need quick tools, 50 to 100 basis points, that's a safe assumption. But again, case by case basis, market by market basis, and really just you want to ask the fundamental assumptions. Who's the renter? What do they think about the market? What does their outlook look like? And what is my target property? What am I offering? Is it equal to what the market wants? Is it less than? Is it better than? And all of that should then funnel into your final assumption of this is our exit cap. This will be our exit ask. So I know that's a lot. I kind of just like threw at you, data dive real quick. I hope that's helpful.
It is. Yeah, thank you for that. So moving on to kind of, well, I guess the main topic, the state of apartments in Arizona. What are you seeing across kind of the big metros? I don't even know Arizona that well. I would say Phoenix, Tucson, maybe Scottsdale. Those are the cities that I know.
It's okay. You'd go Phoenix, Tucson, Flagstaff is kind of your big
Okay.
looks. Scottsdale's wrapped up into the Phoenix metro.
Okay.
A lot of people are a little skittish on Phoenix just because everyone saw it rise up during 2021 and 22, and then they saw it kind of level out or even dip a little bit in 23. And there's a feeling of a big crash. Right? There's a feeling of, oh, we're overbuilt. Every day I drive up the 44th Street, I see construction everywhere. I mean, there's going to be too many apartments and we're going to die. It's just not true. That's not true. When you run a supply and demand fundamental analysis for the Phoenix metro area, and I do this once a week, we're short 30,000 units if everything that was proposed came online today. Right? So you go, fundamentally, there's not enough units for the number of people that want to be here. We got to see some rental increases that weren't received well, and we saw vacancy creep up a little bit. But it's understanding why is that the case. They didn't leave Phoenix. They moved in with friends. They moved with family. They cohabitated a little bit to try to save on costs, and that just makes it like an 18-month timeline. But on balance, I'm seeing that cap rates are staying pretty steady. They're around a 5 for V class. A class is going to be closer to a 6 or a 4, depending if it's BTR or not. But they're not really jumping up, 100 to 200 bips high, and they're not dropping down 100 bips low. So we're not seeing that volatility that everyone thought. There was a little bit of a reality check for some people who they made that fundamental error of using that going in cap rate on your actuals with pro forma income to misrepresent the value, and they overpaid. And so you see a lot of those operators who overpaid on short-term adjustable rate mortgages in 21 that are now scrambling. And that's, well, the market's gonna eat them up because that's what a healthy market does. On balance, I see there's still a strong need for multifamily units. There's some stability there. The government economic drivers support it. There's good landlord rights without squashing the tenants. I see the Phoenix market still being a top 10 metro for the next 5 years. If you look at population trends, where it's going, people are still coming to Phoenix. We're having a net positive inflow rather than an exit. So however you shake it, we got more people coming in. We're not losing as many as everyone feared. The water issues are not there. Everyone thought there was a huge water problem being in a desert. Turns out we have really good aquifers. We're doing great. All in all, I see Phoenix as a stable, strong growth market. You're not going to see that 20% a year value increases that people saw 2 years ago, and there isn't really a rug pull going on either. Again, that applies if you understand what goes into the economic drivers of an apartment complex. So, I mean, what I see some vacancy creeping up, and that's healthy. If you have a 10% vacancy, tenants have enough options that they don't feel stuck where they're at. So it keeps landlords from doing the lipstick on the pig remodel, where they slap some paint on a C-class apartment, they call it a B, and they raise your rent $200 a month. That doesn't fly anymore. If you're going to renovate, you have to actually improve it. You got to put in the solid surface countertops, maybe some backsplash, solid surface flooring. You got to take the right steps. But if you do, those tenants are responding. So, all that being said, I think the Phoenix market is doing a lot better than some people would like to state. Some people on LinkedIn have said, "Oh, Phoenix is kind of going down." Well, not really. If you understand what's going on, but you have to dive into the data. And again, I will say you got to adjust your analysis on a case by case basis. There are certain markets where apartments might not be doing so hot. So New York is one I've been watching. It's not necessarily the great place, but if someone sold you an apartment for $1, you'd still buy it.
So, I'm ready to move in right now. Just tell me.
So it's I think the Phoenix market overall seems really healthy. But for any investor who's watching this, I understand it's always going to be case by case, but really look at those fundamentals to assess your true rate of risk.
What would you say the big economic drivers are bringing people to the big metros in Arizona, besides just leaving California behind?
Sure. I mean, you could talk about the leaving California. You could talk about how Phoenix is, like I said, one of the top 10 biggest metros in the country. People often forget that. Phoenix is I think we're number 6 right now, like 10 million people. So people leaving large metros like it because they can still get access to the unique amenities, unique restaurant options. There's a big drive for jobs right now. We have the TCSM, Taiwanese super chip manufacturer. We have a couple different car manufacturers that are coming in. So there's some good underlying job growth. Okay, who are the top employers? How are they handling things? We have some good universities, ASU, U of A, and those seem to be doing pretty well. You look at, okay, how's their tuition going? Are they staying full? Are they still getting students? Well, when they graduate, not all the students go back home. Some of them say, well, I'm already here. I've been here for 4 years. I have a lifestyle, I have friends. Let me get an apartment right across the street. Let me move into Tempe townhomes. Let me and that's a strong like gravitational pull that keeps people. I mean, you could talk about family growth, people leaving more dense metros for larger space. Phoenix is one of the top markets in the country for build to rent communities. So when people go, hey, I can't really afford a home, but I would love to experience it. Well, here's an entire community dedicated to people like you. You want a 4-bedroom with a yard for your dog, or you want to live close to a school for your kids. You can't quite afford that mortgage, especially at a 7% interest rate, and it's $450,000. Most people just don't have that. So again, it's going to be really diving into what makes a community what it is. And okay, we're looking at jobs, we're looking at population trends. I mean, simple report, you can look up U-Haul. I don't know if you've ever seen the U-Haul annual reports.
Yeah.
Where are the trucks going? Is it cheaper to go to or away from? And that will tell you faster than the U.S. Census Bureau. The Census Bureau is always 5 years behind, and they go, we think. The local city is always going to over-report the numbers because they want it to seem really good.
Yeah.
You vote with their dollars. They vote with their feet, and if they like a city, you'll see the U-Hauls moving in. If they don't, you'll see them going out, and that tells you right away. It might be a fantastic city to live in. You might really love it, but I mean, if everybody's moving out, eventually there will be no one to fill that space.
You mentioned built to rent, and we love built to rent. My partners and I, we have 500 homes about under development, built to rent in Louisiana and Alabama. Not top 10 metros though. They're still nice areas. How do you see built to rent growing in the Phoenix market? Because Phoenix is one of the poster childs in the country for just massive BTR communities, wherever you look. How do you see them performing and comparing to your traditional multifamily?
I I love BTR. I think people need to not conflate it with traditional multifamily because it is inherently different. And this is my humble opinion. You guys can tell me I'm wrong, take it or leave it. I think one of the true indicators of a BTR community is it should look and feel nearly identical to a subdivision. You can't have 15, 20 units an acre, right? You can't have this highly dense, highly compact BTR because then you're just a low-rise apartment, right? People want a yard. People want some type of garage. They want something like that. And the great selling point for a BTR community, at least on like a government perspective, is if you individually parcelize all of the homes, worst case scenario, the developer could turn around and sell them. You can always sell the homes to tenants. You can do rent to own. You have options. And putting those options on the table is really important. In Phoenix, making it feel like it's still a subdivision is critical for getting it approved. That's absolutely critical. That's one of the best ways that homeowners are more likely to say yes to approval, whereas like they might not agree with a low-rise or a mid-rise apartment complex, but they'll say, hey, that looks like where I live. Go for it. Build it up, make it nice, make it pretty. I think build to rent is here to stay. I don't think it's a fad. But again, worst case scenario, if they did it correctly and they individually parcelized, you're doing good.
Yeah. One of our developments, the homes are individually platted. The other two, it's a single plat.
And again, this is all metro by metro basis. I haven't looked at either of those markets. I can't speak to them.
Yeah. What would you recommend for people who are looking at investing in Arizona? What markets would you recommend they explore? What would you recommend they stay aware of, especially like you said, with a lot of these newer syndicators, getting carried away with the hype, and now that there's going to be some pain? How can people avoid that while still benefiting from the growth that's happening in Arizona?
Sure. Yeah. So one of the best things you can do is, again, you want to really understand what is your target market, what your what's your goal, right? If you're looking for fast, quick turn growth, okay, there's some good markets for you. You know, up and coming markets. Mesa is a great market. You know, people. It's a town or it's a city inside of the Phoenix metro area. You know, but their population is it's over 150,000. You know, it's a strong, growing neighborhood. Um, you know, there's a lot of young families, and they love it, and they're dedicated to the area. Um, Gilbert has been a really strong one. Surprise is pretty good, especially for like 55 plus active adult communities. You know, so like it all depends what you're going for. South Scottsdale is, you know, for lack of a better word, it's very bougie. You know, it's really nice. You know, but most people aren't accustomed to buying in Phoenix and then having a minimum purchase price of 600 a unit plus. You know, that's like, oh, that's you're paying top dollar, but you're getting top dollar. So what is it that it all depends what you're looking for. Are you looking for a long-term hold or a fix and flip, or you know, maybe have some options, a little bit of both? Uh, the market,
Maybe like a top market for appreciation and then another market that's better for cash flow.
yeah. So I mean, North Scottsdale, Deer Valley, Mesa, Tempe, and if you get in Phoenix, like Midtown, right above like downtown Phoenix, all of those markets are doing really, really well. Tenants seem to respond really well to the rents. And again, it's going to be about what's the makeup of my complex. Now I know last year all the rage was buying a motel and renovating it, turning it into an apartment complex, and going to make a bunch of money. If the purchase price is there, then it makes sense. But in Phoenix, it didn't work as well because nobody wants to live in a studio. You know, they're like, hey, that's neat, but I want room, I want space. So you're really going to have to consider that. Some of the areas I've seen in Phoenix, you also want to be careful. A lot of people shy away from, so like Mesa is a great one. People used to shy away from Mesa, especially towards the eastern side, because 100 years ago, you know, that was camping ground, you know, and then it was mobile home parks, and then it was lower subdivisions, and it had a reputation of very low growth, and I wouldn't invest there if I didn't have to. Well, the data doesn't show that anymore. And so you have to get beyond those presuppositions that local seasoned investors might have. So they'll go, I know Apache Junction. I looked at a deal there 10 years ago. It was terrible. I'll never look again. And that's not the case anymore. You have to really consider everything with fresh eyes, as fresh as you can. Because when public's sentiment doesn't match the data, the delta between those two is called profit.
Yeah, I like that.
So if everyone says, I just don't like this, or at least the syndicators, the operators, brokers, I don't really like this. Okay, well, but the data says something else. I I think I'm going to go for it anyway. And there you go. Everyone will say, I can't believe, like, how did I not know that 5 years ago? Presuppositions speak a little louder than we all think they do.
Be greedy when others are fearful.
That's right.
How do you see regulatory changes impacting investing in Arizona? You know, both just at a high level, landlord versus tenant friendly, maybe like anything with like Airbnb laws that are happening, because I feel like that's something that's going around the country.
Yeah, Airbnb is a tough one because I totally get it. If you buy a nice home in Scottsdale, you're surrounded by, you know, people playing for the Suns. You know, it's got a certain feel. Last thing you want is your neighbor who doesn't live there to be throwing a rager for, you know, a couple $100 a night. Yeah, that would really eat away at my happiness. So a lot of people have worked together to try to kind of crush those Airbnb party homes, um, and they force some registration. That's okay. I don't foresee Airbnb uh, as a long term substitution for hotels, but that's a whole nother conversation. The one thing people have been cracking down on is saying, okay, if you're an institutional investor, should institutional investors be investing in single family homes? When I see investors owning 1,000, homes all across the metro. While investors don't make up the bulk majority of single family home, it's not a bad look when people can't afford homes. So eventually there might be some government intervention to say, hey, if you have a net worth of X, you can't own more than however many homes. Or if you're a fund, you can't be buying single family homes. That might come into play at some point. I haven't heard anything, seen anything substantial. In terms of rent control, we don't have that. And as a culture, I think we're pretty well established in that fact. As an appraiser, I can tell rent control was really good intentioned, but it hurts a lot of people,
Yeah.
landlords included. I've seen it where tenants they don't benefit. The ones who get it, they might benefit a little bit, but for every one that gets it, there's 100 rejections. And because of rent control, they don't have options for anywhere else to go. So it's a tough place to be put in. Then landlords, it makes it unprofitable. So then the only new construction is ultra class A, and it cascades, the LA effect, if you will.
Or the New York City effects.
Right,
Yeah.
LA, Chicago, like if they were allowed to double or triple the amount of units and they didn't have rent control, overall rent would go down, developers would make more, and everyone would be happier. It's not a political fact. It's an observable, measurable economic fact. It's just, rent control is a well-intentioned policy that only ends up hurting everyone. So I think that's a sentiment that's well shared in the Phoenix market and the Arizona markets, for that matter. So landlord rights seem to be well protected, um, while also still enforcing the contracts that tenants have. So if I'm a tenant in an apartment complex and halfway through my lease, another landlord comes in or another guy buys the apartment complex, they can't raise my rates day one, but they can raise them when my contract goes up, and that's fine because that means my rights are protected as long as I have them. And so I think that's a fair balance, right? Because that's always what it is. You want to make sure the rights you're buying as a tenant are protected, your rights as a landlord are protected, and no shenanigans are allowed.
And where do you see the state and maybe even specific markets going over the next 5-10 years?
I see it really increasing. Um, I couldn't say that it's gonna compete like a coastal city, but long term, right? You've got good economic growth, you've got good job growth. There seems to be good protection of landlord property owner rights, and the longer those are protected, the more of a disparity you will see from those locations and people that don't. Right, so like if you were going to look at an objective measurement, ignoring all policy or decisions, coastal cities should do better than desert cities. It should. It's nicer. The weather's better. You have fresher fish, but that's not what matters. People vote with their feet. They vote with their dollars. And when you see internal cities kind of booming, a kind of a rush back to the Midwest, a rush back to Phoenix, Louisiana, Alabama, people are going back for a lifestyle. They say, I want to be able to afford to have a family. I want to be able to not be concerned how I'm going to pay for next month's rent. And you look at all of these things that inform a renter, and that will tell you where the growth is going to be. And you can find this out just by, like I said, going to a grocery store, go to a dive bar, and just have a frank conversation with people. How are things? What's going on? So if you're looking for good markets, you go, what's going to support that long term? Ask the people. They'll tell you if you're willing to listen.
And what's your strategy going forward in Arizona? Is it multifamily syndications? Is it, single family residential? Is it fix and flip, Airbnb? What are you planning on or already doing?
Yeah, personally, I'm focused. I'm all in on apartments. I think apartments are the number of apartments are always going to grow. I think the number of renters will always grow faster as a ratio than the number of homeowners, just because that's the way the trend of development is. People build more apartments than they do single-family subdivisions. It just pencils better. So investing in apartments long term, all else being equal, I believe, is a better play. Um, if you're doing a good job as an owner operator, you're not, for lack of a better term, you're not being a slumlord. You offer a good quality product to your tenants. You can actually make a good impact in wherever you're investing. So there's that moral aspect of like, I'm actually doing it good and I'm helping people, and you're watching dollars appreciate. So I'm looking at deals every single day in Phoenix. Part of it's just because I know this market really well, and I've worked on some deals in certain markets where I was like, oh, that's a lot of money coming into this place. I should find an apartment to buy nearby. So there's a little bit of inside scoop that I get just by the nature of my day job. Um, but all in all, I'm heavily leaning towards the apartment market in Phoenix, Scottsdale. I'm really considering them. I personally look at deals under 100 units just because I'm not a fund and I don't have that access to that kind of capital. But all in all, I see apartments as a very positive long-term outlook. I know it's always going to be weird. It's an election year, so everyone's kind of unsure. Bond market's a little unsure. Monday was a fun day if you had a lot of assets in the stock market. But as was it Warren Buffett said, he only loses when he sells.
Yeah.
He gains when he sells. So if you have that long term mindset, you'll be all right. And I think that mentality plays well with apartments too. If someone asked me where apartments can be in 6 months, I couldn't tell you. I don't know. If I knew, I wouldn't be talking to you. I'd be making money.
Yeah.
But I have an idea of where they're going in 5 years. That I can measure. I can quantify. I can go based on these economic trends. That's where we're going. So if it looks bad in 6 months, don't be alarmed. These things happen. The market, it's not a straight line. It's a bunch of little squiggles.
Yeah. That's a nice
So,
thing that it's the long-term play in real estate. There's no, instant nosedives like there were Monday or, I don't know, during COVID, for example.
yeah. And some markets there might be, there could be, like if we said, if tomorrow, Gavin Newsom said, you're not allowed to charge any more than what the government says for apartment markets, and legislation just steps in. Yeah. I think if that happened, you would see a giant nosedive down.
Yeah.
But that's an unlikely effect. And you go, okay,
Yeah.
just keep an eye on what's happening. What are those legislatures saying behind closed doors, and what do the people need? But if you're paying attention to all those important factors, and there's a lot of them to keep track of. There's a lot of them to keep track of. But if you do your due diligence, you can navigate the muddy waters.
And you also mentioned that one of the services that you offer is for investors, retail investors who are looking to invest into syndications. They can kind of show you their deal, the financials, and you said you would give them kind of some feedback from your appraiser perspective, like, hey, this apartment is worth this much, could be worth this much in 5 years, or you should just throw this in the trash. Is that right?
Yeah, well, there's two ways to do that, right? So one, you could say, hey, you want quick feedback? I'm not going to appraise it, but I'll look at your underwriting and I'll give you 10, maybe 20 questions. Go ask the sponsor these questions, and if he doesn't answer them or he answers them poorly, get out. This
Yeah.
is your head. If you want, there's some people who've asked me to do an appraisal. Like, hey, I need a quick, simple appraisal. I don't need all the fluff, but I need numbers. I need to know now. Is this reasonable? And it takes a week. I'm going to do my due diligence. I'll dive into everything. And at the end of it, oh yeah, this is my as is market value condition. This is my opinion. or this is my perspective market opinion. Hey, maybe you're only buying it for $1, but it's worth $1 million. Okay, all right. This is how I got there, and use this how you will.
Okay, well, listeners, you heard him here. Okay, with that, we're going to end with some of the questions that we like to ask all of our guests. So from your journey as an appraiser all the way now to getting into multifamily investing, what are, let's say we'll say one. What was your biggest failure along the way? What did you learn from it? Yeah, how did you move past it?
When I was earlier on, especially before I got certified, um, I was armed with a little bit of knowledge,
That's
and
dangerous.
I didn't realize how dangerous that was.
Yeah.
Thankfully, I had a really good mentor, and he kind of nipped that in the butt. It was like, hey man, you don't know what you don't know right now, and there's a lot you don't know. But when I was younger, I would speak out of turn, and I would overshare, and when I didn't know something, I would communicate. Oh, I think it's this. I'd fill in the gap because I wanted to be an expert. Um, and I think that hubris, that pride, was really dangerous. Uh, Not that we're not all susceptible to pride or arrogance, but really taking that humility to go, no, this is what I do know, and I will be upfront of what I don't know, and these are the assumptions I made. So that mistake was just not learning to either ask good questions or be clear on what you don't know, and say, hey, we didn't know, but this is the assumption we made. If we're wrong, we can change that, and it'll flow through accordingly. Um, Whether you're on a syndication, you're on a deal, if you don't know something, ask. And if it needs to be answered, make sure it gets answered. And if they're saying, "Oh, we don't know, it doesn't matter," like now you've got some red flags. Um, and so for me, I learned to ask better questions and to be careful, to make sure I knew what I was saying before I said it. So little exposure in my failures, but I hope that's encouraging to other people. Check your pride at the door and be honest about what you do and don't know.
Wise words. And how do you give back to your community?
That's There are a couple different ways. So personally, my wife and I are married. We have 4 kids. So we give back just by helping out other families as much as we can. Sometimes parents need babysitting. Sometimes parents have questions about raising kids, or how do you raise kids and be a professional in the workplace. Just diving into those conversations. My wife and I were really involved in our church. I believe a strong religious background is really helpful, and it's helped me professionally to maintain a high ethical and moral standard. Um, I'm a part of an organization called Get Phoenix. It's a small local nonprofit. They help young professionals break into their industries. And so I'll talk with guys, and they have questions. Young, a new guy in the industry goes, "Hey, how do I handle these things?" Yeah, I'll tell you, and you may or may not like these answers, but do with it what you will. When I was coming up, some people didn't share what was going on. They didn't share the sauce. They're afraid that if I give you too much, you'll be my competitor, and really that's a poor way to look at the world. So I've tried my best to mentor however I can, to share however I can. I go, hey, you're an engineer. You're not an appraiser. I'm an appraiser, not an engineer. But I can tell you this is what I've learned. Having been in this industry for 10 years, you're just starting yours. Figure out the questions you need to know and start asking. Ask for help to get there. And some people seem to appreciate it. So just having an idea of how to give back, of wanting to give back, and you'd be surprised at how many opportunities come knocking at your door.
Gotcha. Well, that wraps up our episode for today. So thanks so much, Jason, for coming in to talk and teach us more about evaluating deals, and especially the real estate markets in Phoenix. To learn more about the state of apartments in Arizona, feel free to reach out to Beakley at 4cv.com. and visit Jason's website, 4cv.com. We will include the links to those in the show notes. So again, Jason, thanks for hopping on and taking some time with us today. For those of you listening at home, don't forget to like and subscribe to our podcast wherever you're listening to make sure that we can continue bringing you the best educational content. Thanks, everyone. And until next time, keep learning to invest for generational wealth.